Good morning, everyone. It's Ben Buckner in Chicago and Dan Basse joining us from Brasilia, Brazil. It is March 2nd, Monday, and markets been quite volatile overnight, mostly lower this morning. And of course, we were contending with a lot anyway. The wheat market sort of resetting based on a pretty solid trade and the incoming new growing season. And now we've got to contend with expanded conflict in the Middle East, US and Iran specifically. But I think we want to come to you this morning and communicate that we're still focused on fundamentals, and it really only a few things matter to us when we think about risk management, price discovery. And Dan, I will let you jump into that from Brazil this morning. So I pass it to you.
Yeah, Ben, well, thank you. We've got meetings, presentation today to the Bank of Brazil, which is one of the largest financiers of Brazilian agriculture. And then the Ag Minister of Brazil will be there along with his cabinet. So we're looking forward to doing all of that here in Brazil today. That being said, there's a lot of anxiety and a lot of turbulence, a lot of volatility surrounding what happened on Saturday while the U.S. and Israel attacked Iran. Now, interestingly enough, when you look backwards in time, Venezuela was a significant, one of the largest crude oil suppliers to China. Now the United States has gone after Iran and doing the same thing. So when you think about geopolitics, I believe that this war is really embedded in that. We, of course, had bad leadership in Iran for many, many decades. I mean, that goes all the way back to Jimmy Carter in 1979. That being said, I think now we're to this point where leadership has been dismantled. We're looking for new leadership and a regime to step forward. And I think what really comes forward to me is that a lot of this, of course, was making sure and fomenting the U.S.'s position in terms of a world power, but also making sure that it stands up in terms of a reserve currency. Because Iranian crude was traded many times in rubles or in yuan, and that's something that on a longer term perspective is just not allowed. So this is important. It's a mixture and a changing of the guard, particularly for China, and how China reacts will be very key going forward. That being said, I think it's important to look at what's happening in global soybean trade, at least since then. If you look at the Chinese, it has been dramatically increasing the amount of loadings that are heading in their direction. Now, we see in blue in this graphic, this is soybean exports to China based on our vessel counts at Ag Resource. You can see, of course, in blue, we started to see some additional demand from China, from the United States in a 12 million metric ton deal. That will continue through probably May. But that being said, look at the amount of red that is showing here in terms of February and March, which are Brazilian cargoes that will be heading to China. Now, a lot of this, of course, is the Chinese are seeing cheap Brazilian prices. We'll talk about that in a minute. But I think backwards, as this conflict with Iran broadens, I really wonder if the summit that is planned between Trump and Xi will happen in early April. If the conflict is ongoing, I think it's very difficult politically for China to hold the summit. That being said, I also don't believe that the Chinese can buy U.S. soybeans per Trump's request of the 8 million metric tons nearby. So as Trump's bombing much of Iran along with Israel, it's going to be impossible for the Chinese to buy U.S. soybeans. That would be a wrong-footed message. And then again, there's a lot of doubts in the market growing about whether the U.S. and China will have a summit in early April. And that fraying of the political and economic tensions between the United States and China is really what the markets are about. If the United States does not sell another 8 million tons of soybeans to China, it changes a lot of things. Of course, we saw back on February 4th when Trump asked the Chinese to buy U.S. soybeans, there was a very sharp rally. Then we saw geopolitics coming in here, which has caused the wheat, the funds to cover their short position in wheat. Now we're seeing a lot of that in corn. So as we look back, it's been a month of geopolitics in February. Now we're seeing that continue forward into March. When you think about China and all the soybeans that are headed its way along with its oversupply, we are looking for auctions out of China. You can see here in the hog price within Dalian that indeed we're setting new lows. So the Chinese are still struggling mightily, if you will, with hog profitability and overall supply. So I don't see any indication why China would need additionality in terms of soybeans. We are increasing their slaughter in China. We are increasing pork production. Some firms are trying to hang on to what they have, but as you go forward, negative margins are not going to be good for global soybean trade. And looking at where markets are here today, you can see that the Brazilians are about, $35 to $45, about $1.05 to $1.15 cheaper than the US Gulf. And so a lot of Chinese buyers have been really focusing on that Brazilian supply. Now, Argentina is becoming more aggressive as we look forward here, but US soybeans are just expensively priced in the world market, which is that captive demand then of 8 million metric tons becomes so important for soybeans to hold above 11.50 a bushel as we think about the weeks to come. A little bit about global trade. AgResource every week looks at vessel counts. We try to take our AI systems that we're developing and look very carefully at vessel traffic around the world. You can see in this graphic here, we have soybeans down about a 1.3 million metric tons through the 26th of February. When you look at corn, it's up 5.2. Wheat is the big gainer, up 12.1 million metric tons, which is part and parcel to the reason of why funds were covering some of their short position ahead of the geopolitics that came out this weekend. Global soybean supplies, however, standing back from the market, and I think that's what you have to do in these kind of times when the world is unsettled and we don't know exactly where the price of energy, where the price of a lot of things will be heading because of the geopolitics that are at play. You can measure me in terms of how many times I'll say geopolitics in this video, because it's going to probably be more than 10 or 15. That being said, global oilseed supplies are abundant. There is no shortage. I'm down in Brazil. We will release a crop estimate after our 6 weeks. It will be over 180 million metric tons. I can't give you the exact estimate, but it's a big crop in Brazil. So we've got to think forward in terms of what that means to global pricing. And if we don't have that captive 8 million metric tons, we can see bean prices slumping back towards 10 to 10.25 a bushel again, if that is indeed the case. This is where the politics between the United States and China become really so important. As you think about global soybean trade, it is down, and I mentioned that in that graphic, and we think it will continue to slide. And so that will give us record large global oilseed and meal stocks, which is why we're bearish of soybeans and meal longer term. So when we think about this, we see that the overall stocks of meal and meal equivalent rising to about 167 or 169 million metric tons. Then if the U.S. has another record crop due to expanded plantings this summer, that just adds on top of that. So if you're a producer, I want you to think forward. The other thing that's happening very quickly in the United States market, which we'll point out here in Brazil, is that we're becoming more domesticated in our soy demand profile. What you're looking at here is you can see U.S. soybean demand has plateaued. That is that top black line. But increasingly, crush, that bottom line, is increasing. And so the market in the United States is trying to become more domesticated because of RVO, SREs, and all the other things that are playing into the markets here today. This is very important to understand. Now, today, we've only got 3 new plants coming online this year in terms of crush, very few for next year. So when we think about U.S. crush capacity, it's all about utilization of that capacity. We're getting very close to that in terms of a peak. We think about 27, 90, 95 million bushels as being the peak. This is why that 8 million tons of demand to China from an export perspective looms so large in the market in terms of price analysis longer term, and why it's the big kahuna in the room, if I can say that, in terms of a price analysis over the next 6 or 7 weeks. Will that summit happen in China or not? Will the Chinese and the United States drift apart? Those are very key elements to the soybean and total grain outlook here in Chicago. So that, Ben, I want to kind of wrap things up here, and we'll kind of, go forward. But, we believe that farmers should still be managing their risk, making sales on rallies. The wheat market, we did some pricing for the 27 crop. We'll think about the same thing for corn and soybeans here in this rally. Unless you have weather problems, I really think this is a longer-term selling opportunity.
Yeah, I think that's right. And a lot of stuff has happened, and it's hard to be too smart about what price discovery will be in the next couple of days. But I think something that's come out, and people are looking for guidance, of course, is, and we respond with saying we haven't changed any U.S. balance sheets from everything that's happened. And if we've done anything, I think we've been raising corn production in Argentina, soybean production in Brazil. So we think about physical cash supply availability, it's been pretty robust and larger than it was 30 days ago. So that is the concern that we've got. I think, Dan, you're right in terms of like, what can you do? What do you do now? And it is rewarding rallies with new crop hedges and looking at 2027 starting. Because again, if you don't have a weather problem, we're going to repeat last year's kind of midsummer to early autumn price action, and that gets pretty weak like it does most years. So that is a concern with ag resource. And the Iranian conflict, we think about what it means for U.S. and China. That is still priority number one. That is probably all that matters over the next 90 days when we think about fair value in soybeans specifically. So again, volatility is back. There's a lot of uncertainty, but our tune hasn't changed with respect to strategy in 2026 yet. So be prepared. We'll leave it there. We'll be back later this week with everything you need to know, and good luck in the markets today. Thanks.